National Australia Bank senior economist Brody. Viney, he joins me from Melbourne. These figures are even a little better than your forecasts.
Thanks. Yeah, thanks for having me. They're certainly, I'd say they're broadly in line with what we were expecting for the quarter, and certainly showing that that gradual slowing in demand in Australia that we've been expecting to see through this year as those inflation impacts and interest rate impacts hit households. So a 0.4, we had a 0.5 as our final estimate for the quarter. 0.4, a little below that, although it does look like the Q1 number has been revised up slightly as well, so a 0.4 there. But we're really focused, I think, particularly on the consumption number, so how much are households spending and consuming, and how are those impacts of inflation and interest rates flowing through to households. So at 0.1 growth for the quarter for household consumption, that is certainly very slow, basically broadly flat, which is sort of what we've been expecting and what we're expecting to continue to see for a little while. And we did see households, continuing to cut back on discretionary consumption in this quarter. So 0.5 fall in discretionary consumption. That's on the back of a fall over the last couple of quarters before that as well. So seeing households sort of rebalancing their spending and focusing on those essential goods and services as opposed to where they've got room to make those discretionary choices.
And of course, yesterday, the RBA, in its decision to keep interest rates on hold, said the last 12 interest rate rises are working to rebalance supply and demand. This is essentially what the RBA wants to see, isn't it?
I think that's broadly right. And we also have to remember with this slowing that we're seeing in the economy, it's from a high starting point. So growth was certainly very strong through 2022 as the economy was coming out of those lockdown impacts and the disruptions that we've had. And so, from that high starting point, it's somewhat natural to get some slowing. And then on top of that, as you say, the RBA is looking for that slowing in demand to show that those rate rises that they've put through are working to sort of bring a better balance between supply and demand in the economy. So I think broadly these numbers would suggest, and certainly with that soft or broadly flat consumption number for the quarter, that would certainly sort of confirm that those rate rises are having the intended impact that the RBA has been looking for.
However, it is worth noting that this is a backward-looking number. It takes us up to June. Are things slowing further in the current third quarter that we're in, do you think?
It's early days, certainly. The numbers that we have for July, which we have some information about retail sales and NABs own transaction data that we watch, as well as the business survey, suggests that the economy certainly hasn't fallen over as Q3 has got off to a reasonable start. There's still, some uncertainty about what that looks like as the rest of the quarter plays out. We're still expecting that sort of gradual or that slowing to continue. So fairly soft consumption to continue through this quarter and really for the next couple of quarters as those rate rise impacts continue to flow through to households. We know that happens with a lag.
And of course, we saw the per capita GDP fall into negative territory in the March quarter. That has been maintained in the June quarter. So even though we're not in recession by any stretch of the imagination, for households, it may feel like we are to a degree.
That's exactly right. So this is something we've been watching really closely. We know the population has been rebounding really strongly from those closed borders. And so that's flowing through the economy in different ways. We're seeing that in how tight the housing market is, but we're also seeing it starting to ease some of the labour shortages that businesses have been seeing. What does it mean for GDP per capita? Well, we are seeing that as growth overall is slowing, that on a per capita basis, consumption and growth are moving backwards slightly. So that does say that individuals are really feeling the pinch, even if that growth in population is helping support the economy overall.
And just very briefly, of course, the RBA will be looking at these numbers very closely. Do you think it will change the outlook for the RBA in terms of the direction of interest rates? And what are you anticipating will be the peak cash rate?
Yeah, I think these would broadly be very in line with what the RBA has been expecting. And so it probably won't materially change, their outlook heading into the remainder of the year. At this stage, we still have one more interest rate increase penciled in for the RBA, sort of around November. It certainly looks like that rate rises are certainly very near or rates are very near their peak. So, it's quite possible that the current cash rate of 4.1% will be the peak for the cycle. We don't anticipate the RBA raising rates in the immediate future, but we do think there's still some residual pressures there around inflation and wage growth that will continue to put pressure on the RBA and really, could put them towards wanting to square up the risks around bringing inflation back to the band. We know inflation is improving. We expect that to continue, but, we're still well above the RBA's target band and on their forecasts, not getting back to that 2 to 3% target band until 2025. So that's the risk that they're managing. It's more a longer term risk and making sure that they've got rates at the right level to manage that risk over the next sort of 12 to 24 months. So it's quite likely increasingly likely we're at the peak of rates, but we do think there's still that chance of one more to come.
Brody, Viney, great to get your insights and analysis. Thank you so much.
Thanks for having me.
And Karina, on account of the data that has come out, the GDP rising 0.4% in the third quarter, taking the annual growth rate down to 2.1% from the March quarter's annual read, which was 2.3%. The market has moved ever so slightly, falling just a little bit more, given the data was stronger than expected, which always raises the chances that there would be another interest rate rise, very much at the margins though. And the Australian dollar is sitting at 63.6 US cents, hasn't moved too much after the release of that GDP data.